You know, it's a funny thing. So I have a handful of friends that I have known since I was probably about 12 years old. And once in a great while, we will start to talk about our investments. And admittedly, it's usually because of me, because I'm nosy, and I really like to see how people are investing and how they're kind of planning for their future. But what really boggles my mind is how different we all think about investing, considering we all grew up in the same area with similar families and all went to the same schools. So one of my friends, we'll call him friend number one. He comes from a middle-class family, just like me. But the thing that's unique about him is that when he was going through college, he basically paid for his entire tuition with online gambling winnings. And he has a very risky investment portfolio.
Some motherfucker is crazy, man.
So we recently were talking and he told me that about 70% of all of his investments are in cryptocurrency. And I'm not talking about Bitcoin and Ethereum, which are the mainstream ones. He does hold those, but he also holds a lot of the more risky stuff, those crazy altcoins that you hear all about. And half the time, you know, people are getting a rug pulled from him. He owns a lot of that. Now, another friend, we'll call him friend number two. He went to DePaul University. He graduated, became a project manager at a startup, and essentially he has just invested in index funds his entire life. The most boring investment strategy of all time, but he's obviously not doing too bad. And then the other thing that he does is he owns stock in Wynn Resorts because he likes to come to Las Vegas, and when he does, he stays at the Wynn. He likes that. So he owns just a little bit of stock, but mostly index funds. Now, you may be like one of my friends, right? Or you have your own completely different investment strategy. Regardless of the way that you invest, one of the most important things to understand about investing, whether you're getting started or early on or even experienced, is your risk tolerance. And I wanted to dive deeper into this topic to help you better understand it. So what I did is I reached out to my AI assistant, which is Tiara, and I asked her this question. Hi, Tiara. I'm trying to better understand the importance of risk tolerance while investing. Can you help me?
Sure. I'd love to speak with you about risk tolerance, as it's a very important thing for every investor to understand before putting money into the market. So, what is risk tolerance, and why should you care? Imagine you're on a roller coaster. Some people love the thrill of the big drops and sharp turns, while others prefer a more gentle ride. Investing is similar. If you're okay with the possibility of your investments losing value in the short term for the chance of higher returns in the long run, you might have a high risk tolerance. On the other hand, if the thought of losing money makes you anxious, you might have a low risk tolerance.
Now, I couldn't have said that better myself. So remember in the introduction how I talked about friend number one and how he loved online gambling and he loves investing in cryptocurrency? Guess what else he loves? Skydiving. And friend number two, this is the guy who has the very boring investment strategy, and he's pretty much worked at the same job in corporate for about 20 years. He doesn't have many crazy hobbies. He works from home, he works a lot, and his favorite hobby is probably just hanging out with his wife and his dog. Now, to be clear, nothing is wrong with either of these lifestyles, but I do think it's interesting to see how real life decisions and hobbies and things like that just immediately reflect directly on the investment portfolio and the risk tolerance that people have. So from here, I wanted to better understand what factors influence risk tolerance, and AI had some really thought-provoking points on this.
Everyone's risk tolerance is different, and several key elements can influence how much risk you're willing to take on. 1. Age. Generally, younger investors might have a higher risk tolerance because they have more time to recover from any potential losses. As you get older, you might prefer safer investments to protect your savings. 2. Financial goals. Your investment goals play a big role. If you're saving for something far in the future, like retirement, you might be more open to taking risks. But if you're saving for something sooner, like a house, you might want to play it safe. 3. Investment experience. The more you know about investing, the more comfortable you might feel taking on risk. Experienced investors often have a better understanding of market fluctuations and how to navigate them. 4. Personal comfort with risk. This is all about your personality and how you handle uncertainty. Some people naturally have a higher tolerance for risk, while others prefer stability.
Now, this all makes perfect sense. Now, for me, the age thing really hits home, and that's because both my parents, they're in their 60s, and they're essentially just trying to preserve their wealth that they've built their entire lives, right? So they're invested in CDs, they have bonds, and high yield savings accounts. They're just trying to keep what they have. They're not trying to be risky anymore. And I also think that experience is a very interesting point as well, because I invested in things now that I definitely never would have invested in my 20s, but that's because I didn't really understand these things in my 20s. So now I just have more knowledge, I'm able to invest in more things. But how does someone assess their own tolerance for risk? In other words, if you're just starting out, how do you know exactly what strategies you should employ?
Risk tolerance is not a one-size-fits-all kind of thing, but there are a few ways you can get a good sense of where you stand. Self-reflection. Start by asking yourself how you feel about risk. Are you comfortable with the idea of potentially losing money for the chance of higher returns, or does that make you uneasy? Think about past experiences where you've faced financial uncertainty and how you reacted. Financial questionnaires. Many financial institutions and advisors offer questionnaires designed to assess your risk tolerance. These typically ask about your financial goals, investment timeline, and reactions to hypothetical market scenarios. Consider your financial situation. Look at your current financial status, including your income, savings, and any debts. If you have a solid financial foundation, you might be more willing to take risks. By taking the time to assess your risk tolerance, you'll be better equipped to make investment decisions that match your comfort level and financial goals.
Now, I think the point that Tiara just mentioned about how you react when you lost money in the past is a very, very important one. Because at the end of the day, if you got completely sick to your stomach and you're just nervous even investing money, you're probably not a very risky person. Or you don't mind splurging on a fancy dinner once in a while, then you probably have a higher risk tolerance, because losing a little bit of money, it's not going to really impact your mood as much. So it really is different with every person, right? When you're looking at the situation for yourself and your own relationship with money, look at your experience, look at your mindset, and really be honest with yourself to make sure that you make the best investment decisions for your specific situation. Next, AI really wanted to discuss how different levels of risk tolerance can guide your investment choices. And this part is important.
Understanding your risk tolerance can significantly shape your investment strategy. Here are the different risk profiles. High risk tolerance. If you're comfortable with high risk, you might be drawn to cryptocurrencies and certain high-growth stocks. Cryptocurrencies like Bitcoin or Ethereum are known for their volatility, but can offer substantial returns. Real estate can also fit here, especially if you're investing in high-growth markets. Moderate risk tolerance. For those with a moderate risk tolerance, a balanced portfolio might include a mix of stocks, bonds, and real estate. Real estate investments can provide stability and cash flow, especially through traditional property investments or real estate investment trusts. Cryptocurrencies might still be part of your strategy, but perhaps limited to well-established coins like Bitcoin and Ethereum. Low risk tolerance. If you prefer to minimize risk, you might focus on safer investments like bonds, money market funds, and stable real estate properties. Real estate can offer long-term stability and is often seen as a tangible asset that retains value over time. Cryptocurrencies might be less appealing here due to their volatility, but some investors might still allocate a small portion for diversification.
So this video is a really good start to understanding your mindset and factors that will influence your investment strategy. But I did another video recently that I definitely think you should check out, where I talked to AI and I said, hey, when I'm picking stocks, how do I analyze them? How do I pick the right ones? That video is right over here. You can click it and check that out. Really good video. If you're not interested in that one, my most recent video is right here. But this video right here, super interesting stuff. I really enjoyed it. I think you will too. But as always, make sure that you like this video if you enjoyed it and subscribe to the channel to unlock financial success one AI chat at a time. Thanks, and I'll see you in the next one.